As markets sway between green and red territories, should investors with low risk appetite consider investing in passive funds? What plethora of funds available in the market? Which one is a definite buy for you? Let's help you get the answers today for this. And to discuss further, I have Suresh Sadagopan, founder, Ladder7 Financial Advisories. Suresh, good evening. Welcome to the show. So
Yeah,
it's
good evening to you.
not only from the investor's point of view, but we can also see a lot of AMCs, tons of passive funds that are being launched. Now, when we talk about passive investing, it's either you do it through an ETF or an index fund, or specifically talking about index fund. These are really catching up with investors' attention. What, according to you, is the main reason? Is it especially in the large cap category? Is it the underperformance that we are seeing in the active large cap category that is drawing investors towards an index fund for the large cap investment in their portfolio?
Yeah, so Kavita, short context to this. See, what is happening is more and more of these blue chip companies, the top of the line companies, are being followed by analysts. So once upon a time, there used to be an information arbitrage in some of these companies, and fund managers used to have an opportunity to pick up before the information is known largely to the public. But if you look at the top 50, 100 companies, the number of analysts who are following and the information asymmetry, if any, is no longer really there. So if you look at the large cap performance, especially of the passives, you will see that Nifty 50 or BSE 100, these kind of indices are mostly able to beat the active fund. When I say mostly, it is not all the time. There is something called a SPIVA report. That is S&P Global prepares this. S&P index versus index versus active. This is kind of indicative of where we are actually heading. As far as the large cap categories, if you look at a 5-year time horizon, something like almost 89% of the actively managed funds are not able to beat the index. So this gives you an indication of why, in the large cap category at least, probably having passives is a better idea. And as far as, let us say, mid and small cap are concerned, the situation is completely different. Less than 50% of the funds, like something like 47% of the funds are able to beat, 53% of the funds are able to beat the index, which means there is still potential in the case of small and mid cap category for the active fund manager to take calls and give that alpha. So large cap category, there's a very, very clear case of probably going towards passive. Mid and small cap, there is still a case for actives in spite of whatever they may charge.
But we can still see AMCs launching index in the same category that you just mentioned, mid cap and small cap. Is that will that does that help investors to reduce the volatility in this kind of a market scenario? Does it make sense to have an index fund for mid cap and small cap category?
So I actually this question only time will tell. But if somebody wants to invest in a mid cap and does not want to take a fund manager risk is essentially the fund manager choice can go right or wrong. I mean, we don't know. Only in future we will really come to know. If one does not want to take that risk, if one is going to invest in the mid cap or the small cap index, yes, it's possible that the active fund manager can beat the index, the corresponding index, but still the performance of the index is not going to be very bad. So from that point of view, if they want to contain the downside in which can potentially happen in an active fund, and they want to participate in a very diversified manner in mid cap, small cap, I think say still the index funds in mid and small cap are credible choices. This also the current outperformance of active funds. I said 53% over 10 years. Active funds also will taper over a period of time. It may not happen immediately, but it will happen over a period of time as more and more companies start getting covered by the analysts.
So what a lot of times what investors do is that they go towards or lean towards passive investment strategy only because it's more easier on their pockets. They find active funds being slightly expensive as compared to index and ETFs. Should this be a criteria to buy index funds?
Not really. I mean, we cannot look at cost as the only factor. See, there is this element of fund manager risk. I mean, the fund manager, while this person is going to be well experienced, educated, and an expert in that area, there is a human element in it, in the sense that they may pick up wrong choices. I mean, it may prove to be wrong in the future. As far as if you want to eliminate the fund manager risk, then a passive fund will be a better choice. I mean, one of the factors in a passive fund is, of course, the fund management charge itself, but that is not the only reason why we should go for that. So again, one more context from the past. I mean, if you look at 2019, 2018, in that period, if you look at even the performance of the Nifty 50, only a few stocks, about 5 to 7 stocks, were actually driving the Nifty at that point in time. So if the active fund manager did not have those stocks, that active fund will be massively lagging the index. So the index fund does not have those kind of problems. It is far more diversified, and it will have the same components in the same percentages as the underlying index, and that is what is making it very, very attractive.
Yeah, the kind of categories, an investor is offered, Suresh. You have a large cap, mid cap, small cap, a multi cap, a flexi cap. Now, with this wide variety of market caps in one particular portfolio or in one particular fund, how can one decide that which category should be an index and which category should be an active? Because you really don't want to lose out on that alpha that you might earn from your active fund also. How can one diversify actively and passively in their portfolio?
So, I mean, it is probably not the right way to just maximize the return. We will also have to be cognizant of the risk. And if somebody is aware about which categories are performing, which category of passives are performing well, then they can actually invest in that category. I have told you already that large cap category passives are largely performing better than the active funds for the most part. So that is definitely a category where probably a passive fund will be a good choice. And as far as diversification is concerned, I again reiterate and come back to the same point. As far as diversification is concerned, an index fund, like let us say a Nifty 50, Nifty 500 index fund, for example, it captures the entire market. So that particular fund, as compared to, let us say, some other flexi cap fund, this comes in flexi cap category, as compared to another flexi cap fund, may, I mean, whether the performance is higher or lower is not the point, but it actually fully captures in the same way as the index captures it. That particular scheme is going to capture that exactly, and that is what is very, very attractive. You get the wisdom of the markets and you get a certain return. The potential outperformance that fund manager gives is not always replicable. I mean, out of 5 years, maybe 2 or 3 years, there can be an outperformance. There will be underperformance in some areas. So there is a case for passives. If you look at the way passives are constructed, uh, by choosing passives, one will not exactly go wrong. It's possible that they may get a slightly lower return in some cases, but I wouldn't really worry too much on that. What I will leave for the viewers in this question is that what is really, really important is to be disciplined, is to be regular with their investments, not really worrying too much about the choice of fund, as long as the fund manager or the fund house or the category that they have chosen is a credible one.
One last question to you. Index or ETF? How should one compare and how should one decide which is better for them?
So, I mean, I would say index funds are hands down better because you are essentially the counterparty here is a mutual fund. So, which means on any given day, if you want to sell back the units, you definitely have a counterparty who is going to buy back those units at that predetermined price. One cannot say that as far as the ETFs are concerned. In fact, in the case of ETFs, there is what they call an impact cost. While there may be an NAV which may be displayed there, it may not exactly, there is a buy and sell spread, and the price at which you may be able to sell may not be directly the same as what they are actually quoting. And in some time, and in some cases, there can also be an instance where there are no quotes at all. So you will not be able to sell at a particular point. So for all these reasons, I think assured liquidity and no low impact cost, I would say an index fund is a much, much preferred choice. In the case of ETF, there is also one more level where somebody needs to have a demat account. It has to be bought through a stockbroker or through one of those sites which are dealing in stocks. So there is a cost attached to that also. So if you actually take into account all these things, I would say simply that the index fund is a much better choice for most retail investors.
Right, so that's the criteria on which, based on which you can actually add an index fund in your portfolio. Thank you so much, Suresh, for giving us your time and explaining our viewers all about index funds.